If you are making a strategic investment today, 600K, I believe that those investments will probably be worth 660 in another 6 months' time.
Preach.
Hello. Hey guys, it's Domenic Neshi with Sam Assad, Louis Heaton, commonly known as The View. Fellas, how are you all today?
Well,
really good, yeah. I'm good. I'm good for a lockdown week.
Yeah, good for a lockdown week. For all of you that are listening out there, whether you're in the car or in lockdown like the rest of us, I hope you are having a good lockdown week. And for the people that are so lucky to be walking around and out of their houses, good on you. Today we're going to be talking about, we're going to be giving a market update. We're going to be talking about how the market has performed over the past 6 months and give you a little bit of an insight into how we see the next 6 months rolling out. And we've been mixing up the show a little bit. So today we're going to be doing the weekly toss-up. We're going to be comparing rentvesting versus buying your own home. And these listener questions, we've been getting a whole heap of questions from the people that are out there. So continue doing that. We're going to touch on a couple of good questions from listeners out there. And if you wait all the way to the end, we've got a few hot tips and predictions about how we think things are going to roll out, what you should be doing, and how you can capitalize on this market. So I guess without further ado, let's jump into the show. Fellas, I mean, it's been a pretty strong start to the year. One of the fastest runs that the Australian property market has had in a very long time. CoreLogic just recently put out a whole heap of data, and to me, the clear winners have been the smaller states, and in particular, houses. Was there anything in the data that surprised you, or didn't surprise you, and you anticipated it would be like that?
Tom, I think it went as how everyone thought it would go. I think it went further and harder than most people predicted. But I think it fell in line with, if you look back on how the property market's run before, I think the same core assets, or the same real data really reflected what happened years ago. Probably ran a little bit harder than usual. Obviously, we've spoken about the government stimulus packages and the incentives and the mood of the buyers and the auctions. But I think that predictively, I think it went in due course to what people thought it was going to do once the market started running, if that makes sense.
It does. I mean, it is reflective of a lot of the other markets. One thing that surprised me in particular is how hard, the Hobart, Darwin, and Canberra ran. If you have a look at the year to date, you had 12%, 11%, and 9% respectively. But if you get the total return, that includes the rental yields, you're looking at something like 22%, 26%, and 20%, both growth, total annual growth, and gross yield, which is just huge numbers. The major states, or the states that I like to pay most attention to, Sydney, Melbourne, Brisbane, they didn't go as hard or as fast as I anticipated. But I still think they've got a lot of leg work to do. So Sydney obviously grew by 11%. Brisbane ran by 10%, which was a big surprise. But Melbourne only did that 5%. Sam, did that surprise you to see Melbourne only do 5% and in fact have that sort of negative, like the yields really suffered, like the rental returns only at 2.9%?
Yeah, look, I think I've mentioned it previously. I feel like there was some confidence lost, with their lockdown that they went through, late last year, and that rolled on to this year, even though there was some serious confidence, some surge, some really good hype that was happening. But I feel like a lot of different other factors got played into it. And I feel as though Melbourne was the less attractive state to purchase into, because of those because of the way, the market, started off, and I feel like there was an emotive response to it as well, and that all plays into the role of just general growth. So it's some growth for Melbourne, I guess, for the last 6 months, but not as well as the other capital cities, no.
And it isn't surprising because Melbourne was locked up for so much time. But when I dive into the data, one thing that is a big standout to me is how much houses in particular outperformed units. And that's more or less across all the states except for Hobart and Darwin. They had some incredible results. They had 11% price growth in apartments in both of them, or 11.3, 11.4. But when you look at the other states, it's kind of, Sydney's apartments moved by sort of 5.3%. Brisbane and Melbourne grew only modestly. That wasn't so much of a surprise, but I think for me, it's a bit of an indication that it looks like it's an opportunity. I think, we often talk about it, how, houses run, historically speaking, and then apartments soon follow. Or Sydney will run, and then Brisbane kind of follows, Melbourne kind of follows. So there's these leading and lag effects. So when I look at the data, I see that houses have run at 10, 15%, 20% in some states, and the apartments only moved by 2, 3, 4%. So as, investment analysts, for me, that was one of the most obvious signs that, hey, there's something that we should be paying attention to.
I agree. And I like that you've mentioned that, Dom, because, I think everybody just follows the hype and everybody needs to purchase a home. But I think you said something really, a little bit profound by saying that it isn't, it's actually an opportunity for yourself. If you're buying into something that people are probably, steering themselves away to because they're fixated on a certain kind of purchase, I feel like the redundant dwellings are going to come and follow through and follow suit, and will ebb and flow to the point where they are giving you sustainable returns.
Dom, do you think that, and Sam actually, do you both think that, we get asked all the time, Darwin or Adelaide, Perth, Hobart, do you think they're sustainable growth? Obviously, they grew what is said to be the hardest. Do you think it's sustainable though?
No. I think that those states have run well. I think those states have run well, particularly because of affordability. I think affordability is been those big things, and also because I consider those markets, they're not regional, but they are more regional compared to Sydney or Melbourne because of the size of the populations.
Second tier market.
Yeah, they're kind of the second tier markets. I do see them as opportunistic. If you don't have a lot of money to spend and you're patient enough, if you're patient enough to go and learn about these markets and you're a bit more courageous, I think that they're good opportunities. But if I'm going to be building a portfolio, I start around, the meat and potatoes, to use, your mum's Irish, and that's what she's going to serve up on the plate. That's what's going to sustain you. So start with meat and potatoes, Sydney, Melbourne, because they're the most sustainable. And then those other markets, Sydney, Melbourne, Brisbane, and then after that, you've got the smaller markets.
Yeah, I agree. And I guess everybody saw that as an opportunity to purchase from a cheaper price point, whether it was an entry price point or a further purchase. But I do feel like at some point the market will turn back into the main capital economic cities like Melbourne and Sydney, and they would still be heated and simmer nicely and stay consistent in terms of growth over the next few periods to come.
Well, Sydney's hammering. It is now coming back in full speed. This month, it's done a tremendous result. And one of the things that we're paying attention to is just the amount of supply. There isn't enough. I think the ratio at the moment in the major markets, the ratio is around 1.1. So that's to say that we're selling 1.1 homes compared to how much is being listed. So we're selling faster than the amount of stock that's coming onto the market currently. So that's telling me that there's a lot of buying energy. People are wanting to buy. And I read a recent report the other day where a lot of developers, a lot of landowners are talking about government not supporting the Australian economy by creating enough land subdivisions, by giving enough DAs or development application approvals. So we're facing a severe supply shortage in the Australian market, particularly in the major metropolitan hubs. So if you look at that, that's really a 2, 3, 4 year indicator on what the market's going to do. So if we continue at the same rate of demand and we've got these low levels of supply, I really think that we're going to continue seeing these types of this type of growth. What do you think? What do you guys think? I mean, we don't invest based on short-term growth metrics. We will take advantage of them if we can see them there. But if we're looking at Sydney, Brisbane, Melbourne, choose whichever state, Canberra, Louis. I know you love Canberra. How do you see the rest of this year playing out? Where are you? What? I know we spoke about this a couple of weeks ago, but we've got new information. We're coming out of COVID lockdowns and stuff. How do we see this next 6 months rolling out?
I think the new the new media and the new government push at the moment is to see I think a lot of we went through a lot of a confident period. COVID sort of it pulled back, our restrictions loosened. There's no lockdowns for a long time, and now currently, we're sort of entering that zone again. And I think that the government changed their view to we're doing great, but we need to get a vaccine movement on, and we can see the back end of this, which I thought about the other day. I think it subconsciously instilled a lot of confidence back into the Australian people that we're actually going to see the back end of this. And I think that may be enough to then still promote, promote more hunger in people to get into the market. I thought that coming into the end of financial year, the packages weren't wearing off. The government couldn't put much more money into, spending into promoting people to buy houses or property. And I thought that may have pulled everyone back a bit. But I think that, to answer your question, Dom, the fact that we can almost see the back end of this pandemic or the back end of the Australia being shut, and we look at migration again, we look at international travel, we look at people coming to the country, I think that's going to be enough to maintain the growth period for, I think an extended amount of time. So I don't think we're going to see it come off a lot, as what we answered this, a podcast or two ago. I think it's definitely going to come back. Every investment, whether or not it's stocks or anything, you're going to see lull periods. You're going to see, a correction. I think there will be a correction, but I think that now we forecast at the end of the pandemic and we can see where we're going to head next. I think it's going to be able to maintain a level of growth that if you're looking to get into the market now, you're still going to get a win.
So let me just hammer in on what you've just said there. You've just said that, we can see the end of this pandemic coming, and there is a bit of confidence there. The government has created a whole bunch of new incentive for, single parents and first home buyers, Let me ask the question more plainly. Will we see the same growth that we had for the first part of this year into the second part? Like, yes or no?
No.
Yes.
I love it. So you think so? Yes, Sam, and
yeah,
you think we're going to see the same levels of growth?
I wouldn't say as hyped up as the first quarter of this year, but I'm going to see some. I think we're going to see some still modest growth as things start to post-COVID normal start to come out. So I feel like we're in this irrational period where there's a shortage of supplies, and I feel like the mainstream media at the moment is subconsciously telling us that we need to do A, B, C for us to resume our post-normal lives. And I feel like that will play into account into the market starting to correct itself and to cool itself. But right now, I feel as though even though things are still moderately growing, there's still that eagerness to get into the market and purchase.
Yeah, I agree. I wouldn't be surprised if we saw another 10 to 15% price growth in the major
Crazy.
markets. So if you put that into context, let's put some of this into context, because some of our listeners have been on the fence and have been unsure and have been hunting for the perfect property and haven't bought anything, right?
Yeah.
And some of our listeners have come forward and said, hey, I want to buy something. Let's get it going.
Yeah.
And for the people that had bought a 600K investment at the start of this year, that property is actually worth around 660, 670.
Yeah.
So that's $60,000 in their pocket. Now, I want to say to all the people out there, I believe that if you are making a strategic investment today, 600K, I believe that those investments will probably be worth 660 in another 6 months' time.
Preach.
That's how I'm seeing the market. Preach. That's how I'm seeing it. Have you guys, I know that you're talking to clients every day, have there been any anecdotal wins or losses because people have skipped out on the deal the last minute or bought the deal and things changed?
Yeah, I've seen some hesitancy based on really on fear, and we all know that you can't base decisions, on fear alone, because you'll make no move whatsoever. But I also am so happy to actually to be involved with clients that have considered investments and have hit the green button and have already seen some mini wins happen within their first or second investment property that they've purchased either through us or wherever it might be. So a client by the name of Charlie, and he listens to us quite regularly. He was a hard client, and he will concur to that. He was a very hard client, bought a townhouse out in West. We got him a really good deal on the townhouse itself. And now I'm getting WhatsApp messages saying, I'm sorry that I gave you a hard time. I know it's worth this much, et cetera, et cetera. So that to me means is that, that there is, a level of, a truth to, what we're preaching and, and what we want our clients to get involved into, because at the end of the day, the proof is in the pudding. And, if you've got in, you'll win. There is still some time to get in, you'll still win, and you're still thinking about it. Procrastination is going to cost you. And that's just all throughout, I think, in any investment journey.
Well, Charlie, thanks for supporting us, listening to the show. We appreciate that. And I'm glad you trusted Sam. You did the right thing. What did that win look like for him? What did he purchase roughly? How much? Can you share that?
I'll share. But, he purchased something. He purchased a 3-bedroom townhouse in a small townhouse development. He purchased it at $620,000. The fellow townhouses are now exactly the same configuration. There's no changes whatsoever. They're now for sale at $660,000 to $670,000. And I have to say that these haven't even been built yet. So he has not incurred any holding costs. And in fact, he's only just put a 10% deposit down and is sitting nice and tight. Now, that's a really, really good case scenario, because he's already now messaging me saying, as soon as this settles, we have to get the second. So for me, this is why I do this is what we do, because it not only gives us a little bit of a kick, but we feel as though is that we're not just preaching, some dream, that people are actually taking these kind of investment risks and are already starting to see some kind of, outcome to it.
Well, Louis, I want to come to you next, but I just want to really drill on this point, because although we don't invest for the short term, the reason why me as an investment analyst and why me as an investor like to kind of put a little bit of pressure and get clients doing things today is because of that exactly. Because the clients that were smart enough to do something 6 months ago are now in a position where these properties are going to be finishing September, October, and they're going to have instant equity. They can redraw on that loan and they can go again. So for any of those purchases, I'm talking to the clients out there that are a little bit more aggressive, not the nervous Nellies, but the ones listening that are a bit aggressive and have got a bee in their bonnet and they want to accelerate their investment journey. You need to act, because if you act in this market while the market's running, you've got this window of opportunity where you can use that growth, redraw on your loan and go again. And that's what I managed to do. I managed to buy a couple of properties very quickly within 2 or 3 years. And then I didn't do anything for a couple of years because we're building a business and blah, blah, blah. and the market didn't do anything, so there wasn't any growth. So this is a really good window of opportunity. Nonetheless, Louis, what about you? Any wins or stories about your clients or people that may have missed out on a deal that passed through your hands and you thought, holy shit, that was a great deal? Or
it's funny when we complete when we complete a set of investments, we only pick up a fair few or only a couple for our investors to look at. So often not within our own ecosystem of our investors, they get snapped up pretty quickly. So one of the people we talk to a lot in our world, they competed against one of our own almost there, but they were hesitant. They said, "Oh, look, I'm going to wait for the next one. I'm going to wait for it." It was a Melbourne townhouse. They said, "Look, yeah, I'll wait for the next one. It's fine. I'm just going to hold off for the time being." They didn't pick it up. Now they're getting the exact same product in a later stage release as we took more on, but for a 40K increase. So
that's 10% nearly, right?
Yeah, it's a tough pill to swallow because it's a tough pill to swallow because they go, look, I'm still getting a property and it's sub $500,000 for a 4-bedroom townhouse. I could have picked it up for $440, but now I'm picking it up for $489. So it's a feeling of a win for one person, but a bitter pill to swallow for someone else. But in saying that, it attests to what we said. Look, this is a good deal now. 6 months time, the next stage of release comes. We pick up a few more selected lots. Same product, same size, but with a 40K increase. So, and we said the same thing. Once these three go, if we do decide as a team to pick up more lots in the same development, same community, they're going to come at another 20 to 30K increase. So,
and that's the thing about this business, right? We have to continually adjust what we see as good value. Every single time we go out there, we've got such a broad perspective on all the markets. You can feel value, right? And you have to continually adjust what is good value because, if you just look at one market in isolation, you might go, holy crap, spending, $800,000 on a 2-bedroom, that sounds like it's too much. But if it's relative to all the other stuff in the suburb, it may be really, really good value. So it's about put it into perspective, I guess. I was going to ask you fellas another question. So I think this is probably a good time to jump into it because I think we've had a couple of clients that have asked us recently. I want to jump into the weekly toss-up, and I don't know if this is necessarily a good name to call it a toss-up, but what do we think? Rentvesting versus buying your own home, okay? And this is a big question that I know a lot of your clients, a lot of our listeners are thinking about, and it's interesting because for them, it's not just as simple as rentvesting, buying my own home. They're thinking about something that is a lot more deeper. It might be something along the lines of, do I go and aggressively make more money versus, say, security? Or do I want flexibility versus stability? And depending upon what part of your life you're up to, my cousin said to me, hey, Dom, his name's Carl. He's like, listen, I can't handle the idea of rentvesting because I want my kids to be stuck in the house. I don't want the landlord to push me out. I want my school I want to be in the local school catchment area. So it's not feasible in his mind where that emotional attachment, the idea of rentvesting, it's too much. He wants to own his own home. He wants to stay in it 10 years, and that's for him. Okay, that's fine. But, for the other clients that are out there that haven't got such firmly set roots, I really believe that rentvesting is a good strategy, and we talk about it all the time. What do you guys think? Let's play devil's advocate, play either side of that thing.
First of all, rentvesting is real. It works. It seems like people don't believe it, or it's not even a strategy to consider. I can talk quite personally about this. I live with one of my best mates of mine. He's picking up his third apartment in about 3 years. Owns 3 apartments. one in the north, Parramatta Westfield catchment. Now he's picked up a second piece of product down south, looking at the Cogra Way, and now he's looking to pick up his final place in the Pennant Hills sort of region. But this whole time he's done his due diligence in a way that he's lived in it for 6 months, or 6 to 12 months. He has, like, over the past 3 years. But now he's rentvesting, he's living in a place where he wants to live. And when we do our cash flows and whatnot, and we're pretty open with each other, and I can see what rents are coming in, where they're going out, his fees and everything, he makes it work, and it works for him. I'm not saying this is a good strategy for someone who has 4 kids and they're more of on the safer side of things. It is a riskier play, and you do get a lifestyle reward. Obviously, he could be saving. There might be some different. There could be more savings to be had if he was to maybe live in one or whatever. There might be different strategies, but he gets the reward in the lifestyle sense. And if you are a lifestyle person, a lifestyle orientated person that wants to still live and at the same time continuously pick up property, then it's a strategy that I think that it is feasible and it does work if done right.
I know the view that Sam's looking at. So he's a rentvestor.
It works for me, though. And it's hard, because when a client says to me, should I buy my own home or should I buy an investment property, I can't really dictate and tell them that how we've been brought up, the great Australian dreams to buy your own home and pay off your mortgage, and try to deter them of obtaining that kind of, conscious security is, the redundant option of buying your investment property. I personally have a handful of investment properties, but I rent, and it's because the way I see it is that I don't need to live in my own home. I don't need to live in the home that I own for me to be able to invest and have nest eggs elsewhere. So I think it's a level of a bit of an education, and also a level of, also knowing what your intentions or your investment strategy is for yourself. So it takes a little bit of time to figure it out, but it has to work for your personal circumstance.
Horses for courses. Yeah, go, Louis.
I think that I can almost say this for the three of us, where us 3 individuals are quite, I don't know, I can't put the word on it, but if we were to get removed from our home right now, the ones we live in, within a week, we'd have another one, and at the same time, our lives aren't altered too much. So I understand where the fear comes from. If you're packing up the family of 4 kids and you have to find a 4-bedroom home that's within walking distance to a school you need to be. That's why I want to make it clear that I'm not, preaching the rent investing, because it would work for me. It's our lives are quite, you can, with the click of our fingers, we pack up our bags and then there's another property to rent, 2 blocks down, because it's not very, we're in a market that it's quite, it's quite versatile. Our individual lives are versatile. Whereas I understand where the fear comes from if it's not for you. And if that is the case, then do the numbers and the digits and really stack it up to see if it is something for you.
See, I agree with everything that you guys have just said. It's not for everybody. It is a time and place kind of thing, and there are certain advantages to living in your own home. I'm considering at some point in time, probably not now, but buying my own home and doing a renovation and then selling it at some point in time, because if you do that, then your own home doesn't trigger a CGT event. So you pay no capital gains on the profit that you've sold it for. Now, it does require a certain amount of skill. It requires like expertise and patience and a lot of cash. So that type of strategy, it is a good strategy, but it needs to be deployed in the right way. Yeah. I think that it's probably not very appropriate to go buy your own home and renovate it and flip it and do a DA, all that kind of stuff, if you're not very experienced or you haven't got the network. And I think that there are safer ways for you to learn about property investment. Renting where you live, where you want to go and have a good quality life, and then investing where you can afford is a very good, easy way for you to step into the market, learn, and then continue investing. If at some point in time you want to go buy your own home, what do the Lebanese say? Mabruk or c'est la vie, or run the life that you want to live, I don't know how many other nationalities I can say, or in languages I can say it in. Okay. So Rentvesting versus buy your own home. It's a strategy. You should go buy your own home if it suits you, but Rentvesting is a real thing and it should be explored. And if any of you are unsure about how it actually works, reach out to the team. We'll definitely help you. Now, moving over to the listener questions, I want to thank you all for submitting your questions. It gives us an idea about what you're thinking about, what your fears are. We had a lady named Ruby submit a question. She's asked,
Hi, Ruby.
Hi, Ruby. Is $50,000 savings enough to start investing in property? Sam, let's start with you.
I'm going to say yes. And I, a bit of a broken record. There is no such thing as a perfect investment, especially for your first investment property. It's about taking the leap. Now, $50,000, that means we have to work with a certain budget. And I assure you, there'll be deals out there, there'll be dwellings out there that are appropriate, for your savings. If we were to toss the coin, and I would say to you, no, by the time you do save up that extra $50K, that you might think that it is comfortable for you to purchase, or you think it is affordable for you to purchase, property prices have grown. So you really haven't really did anything. So my advice is yes, it is enough. It's just about understanding your options, and it's also about knowing what you can and can't do.
Louis?
Yeah, it's more than enough. I think that you can buy a property for a lot less cash than that, but in saying that, it's not going to be the right one. So to answer your question, it's $50,000 is a lot of money, and it can get you a fantastic investment property, but it can also be blown down the drain with a bad one at the same time pretty quick. So I think the cash amount is 100% enough, and you can buy a property for almost a lot less than that. But in saying it can be as we always say, just be very careful in the research you do.
Ruby. Ruby, I think you can certainly go buy a property for $50K. But I want to ask you a question, Ruby. And I know I can't hear your answer, but consider how long is it going to take you to save another $50K, as Sam's saying? Is it going to take you another 1 year, 2 years, 3 years? If it's going to take you let's just assume another year, and the market moves by 10%, that's say $40,000 property may have moved by $40,000. So that's a $40,000 opportunity cost that could help you buy the next one. Now, if it's going to take you 2 years or 3 years and it moves by say 20% over 3 years, that's $80K that you've missed out on. So, I think that a lot of people's trepidation and fear about saying, if I don't have enough money, it's just a fear mechanism. You don't know what the investments are. You don't know what they cost. You don't know how much cash is required. It's good to ask the question here, but maybe go a step deeper, reach out to the team, and they'll give you some specific knowledge about how much it'll cost and those timings. And once you start unpacking that and get into buying mode, you'll learn a hell of a lot. So, Ruby, thank you for your question. Let's jump into one more question, gents. So, okay, this is a long question. I'm going to try and unpack it. Okay, Mary from Sydney. She is interested in investing in property in other major cities versus Sydney, as they are cheaper to buy into. She is curious about what the downside is, if any, and how significant they might be in the long run. So I guess the question that Mary's asking is, should she invest in other cities outside of Sydney?
Yeah, Sydney, yeah.
Yeah, Mary's... sorry, it's not Mary. Yeah, Mary sounds like a bit of a Sydney snob. Let's start with Louis, because I know what Sam's going to say.
100% there is. I think that the real opportunity at the moment is in other capital markets. So I think that there is for sure I'm a Sydney resident myself, born and raised. So I see the Sydney market I call it the premier market. It's the most expensive. It's the fastest moving. But in saying that, I think that Sydney's had its time where it is true that it might be a little too expensive or might be a little overpriced. Not to say there's not good investments in the city, but I think that if you were to dismiss other capital cities, you're doing wrong by yourself.
Yep, agreed. Sammy?
Yeah, just don't be too hung up over your own backyard, So that's how we lose, opportunities. So just to answer and agree, yes, there are really good opportunities outside Sydney.
But just because it's cheaper, it's not better. So
yeah, Mary, Sydney's great, but don't get stuck on Sydney. There's so many good markets out there. Mary, if you've done any traveling, you'll realize you would have experienced the other cities. They're beautiful. The people in Melbourne are pretty much the same as Sydney. People in Brisbane, not too different, same two hands and everything else. I think that Sydney, it can be very scary to invest in states outside of your state, but with the right guidance, and if you take the time and you do your homework, there are definitely some really, really good opportunities. There are some risks, and the risks, you should be mindful of those risks, because there are certain things that you don't pick up unless you go out and see your site or have touched and felt it, or you know what you're getting into. And I wouldn't go buy property without any research. So to answer your question, yes, but there are risks. Just be very careful.
And also look what the economic factors behind the growth of the markets. They can differ in each city. So, don't think that the reason Sydney's market grows is the reason Perth's market grows. So be wary.
Mary, thank you for your question. And to all of you listening out there, any questions, send them through to the team. We are eager to hear what you have to say. Gentlemen, this has been a really good podcast. I've enjoyed it. Now we're just up to the tips and predictions, any hints and tips. What have you got for our wonderful listeners and viewers out today? What have you got to say to them?
Just a little personal tip. Now that, and the financial year or the new financial year has started, set a goal for yourself. And set a goal to get yourself some kind of an asset that's going to anticipate to grow. So those tax refunds will be looking nice and juicy at the moment, but I think the goal should be for yourself is to get yourself involved in investing in property.
Yeah, I love it, Louis.
A year,
the property specialist saying, "Yeah, go buy a property."
Yeah, interesting. A year ago, the world was going to end, and look what happened. So, if you have a negative view of where we are now, please try and remember what we thought back to last year, and then where we are now, and then think about a year's time from here. So. I know it might seem negative where you're at the moment, but I don't think it's 1/7 of where we were last year, and look what happened.
Yeah. I agree with both of your sentiments, and Louis, just to your point, I way things are today are not going to be what they are tomorrow. I'm already getting Charlotte's pestering me every single day because on her Instagram, she's got friends in America that are traveling all over Europe. And she's like, when the hell are we going to get out of Australia? And it's not going to be long. The vaccines are going to be rolled out. I can see light at the end of this tunnel.
Mm-hmm.
But my little hint or tip is to sign up to Wealthi Academy. If you haven't already, there's heaps of really good stuff on there. I spent a bit of time on it last night, jigging things and putting stuff in there. So I really do encourage all of you that are listening that haven't already signed up, jump in, have a little bit of a look around. Even if you intend on buying your own home, or if you've got any interest in real estate, there's something in there for you. And I welcome all feedback. So jump in, refer your friends, and have fun in Academy. And look on the bright side of things. It's sunny outside today. Enjoy the rest of your week, and thank you for listening. Gents, thanks for participating.
Thank you.
Catch ya.